So today is Tuesday, August 10th, 2010, and what we've seen here on the front of Yahoo is the title of the article was Fed Takes Small Step to Bolster Recovery. And what the Fed did was basically what's called quantitative easing. They have printed money once again. They did it in the form of using money from its investments in mortgage securities to buy government debt on a small scale, it is stated. And that this is supposed to take long-term rates on mortgages and corporate debt down. The bottom line of what is happening here is you're seeing the government struggle against the mood of the people. And the government won the battle from the the mid-30s all the way through the most part of the 21st century, through 2008, where we would have the government would print money, the economy would inflate, and then the mood would start to go down. The government would print money again, the economy would inflate, and the mood would start to go down again. The government would print money, inflate, and so the economy would grow and inflate. And the government's using the same tactics, but now the tactics are getting more desperate, they're getting more dramatic, and they continue to turn up the impact of the amount of money they're printing. And so then you have people that are talking about what could happen, what can happen. Well, what can happen is what happened in Japan, where the government printed money and printed and printed, and they had an incredible expansion period in Japan like no other country's ever seen in the 80s, where their stock market was the largest stock market in the 80s. Their real estate prices were incredibly high. There were people in the 80s that were doing government labor tasks, which there's nothing wrong with that, but these people were making six-figure incomes, driving taxi cabs and doing these type of positions in the early 80s, and when $100,000 was worth more than it is today. So, and then, of course, they had the big crash, and they had the 90s, which they call the lost decade, and what you see happen is that since 1989, the Japanese stock market is 72% lower than it was, and it's lost 72% of its value. The real estate has still not recovered to its 1989 peak, so real estate prices are still, here we are 21 years later, and real estate prices are still lower in Japan than they were in the 80s. And so that's one thing that can happen. The government, and of course the Japanese government has taken interest rates down to zero and kept them there for decades. And they have printed money, and the people have responded by saving and getting out of debt and not spending and having fear. So that's where the Japanese economy is. Now, the American people are showing a lot of the same behavior. We see commodity prices about 50% of where they were in 2008 at their peak. We see U.S. stock prices, our stock market is about break even for the last 11 years. And so we have a lot of that here. The U.S. dollar is starting to go up and is up since 2008. And a lot of the experts, like Bob Prechter and Gary Schilling, believe that we're going to have continued pressure on commodity prices. We're going to see the dollar go up. We're going to see there be continued pressure on real estate and stock market, and continue to see deflationary aspects. And when you have deflation, the worst thing that you want to do is be into debt. Where when you have inflation, when prices are going up, debt's not so bad because the value of debt is shrinking on a relative perspective as prices go up around the debt. So the other camp you have is hyperinflation, where the government's going to print all this money that they've been printing for the past 2 years, and all of a sudden you're going to see our currency devalue, you're going to see interest rates go up, and you're going to see the typical things you would see with inflation. Real estate goes up, the stock market goes up, gold goes up, and the dollar and the valuation of our currency goes down. Although it's a little difficult to say it would go down against the other countries because they'll be doing the same thing. So far, we've seen deflation since they started printing money. It hasn't really taken and inflated as much as they wanted to. We've seen the stock market kick up a little bit. We've seen commodities come back up. And so that's what we have here, is this massive struggle of the mood of the people against the printing press of the government, and which one's going to win. Right now, what I'm seeing is that people still aren't lending money, and that's another critical component to money supply, is the credit and economic growth in this country. So it'll be interesting. What's going to happen? You have to decide how you're going to react in your situation if you have investments, but we'll get to that in a second. What can you do? What can I do? Well, we can do the same old ancient principles that have been around for thousands of years. We can get out of debt. I manage individual stocks and pick out individual stocks and have done quite well with it the past 7 years. And I can tell you that individual stocks that don't have debt perform very well. If you don't have debt, then you're doing the right thing. You can go to Dave Ramsey's website and look at his debt snowball. Most of us are fortunate where we don't have to worry about our investments. We just can worry about just getting out of debt, giving away as we feel led to give away money, and living below our means. But I really think that whether we have hyperinflation or whether we have deflation, I really believe that the days of buying the Mercedes, buying the Harley Davidson, buying the Rolex watches, buying the Grey Goose vodka, I really think these days are coming to an end. You're still going to have people doing it, but it's going to be an incredibly fewer percentage than we've had in the past. And Harley Davidson is already reporting earnings and revenue that's much, much lower than what it was during its peak time back in 2006, 2007. So I think you'll continue to see that. The other thing, if you have investments, you have to choose. Do you think that the government's going to win with the printing press, or do you think the people are going to win with their negative mood and their fear? And you have to decide one of those. Now, if you do the buy and hold theory, then you've obviously just chosen on hyperinflation. If you're in cash and you're in bonds and you're never getting back into stocks, then you've obviously chosen deflation. Or you can be like me and say you don't know what's going to happen. And I don't think anyone knows what's going to happen. And if you do that, then you have to have more of an active approach to managing your investments. And that's exactly what I'm helping my clients do, is that if we have hyperinflation and that starts to take off, I'll begin moving my clients' money in a direction for hyperinflation. If we have deflation, then I'll be able to help them protect their principal if we have another crash like we had in 2008. And so that's what you need to figure out with your investments. Moving forward, I suspect that there will be certainly we won't see business as usual, at least not in what we're used to in the 21st century, with the amount of money that's been printed and the amount of credit that has been applied. If you have any question, I do set up free, no obligation conference calls during the week. My 1-800 number is 917-5016. My email is thomas@112fm.com. And it would be my pleasure to answer any questions or concerns that you have about your finances and what you can do during these uncertain times.